Isaac Newton was, by any measure, one of the most intelligent human beings who ever lived. He invented calculus. He decoded the laws of gravity. He fundamentally transformed our understanding of the physical universe. In 1720, Newton invested in the South Sea Company. He bought early, made a handsome profit, and sold. Then he watched the stock continue to rise. Unable to resist, he bought back in, near the peak. When the bubble burst, Newton lost the equivalent of roughly $4.5 million in today's money, nearly his entire fortune. Afterward, he reportedly said, "I can calculate the motion of heavenly bodies, but not the madness of people." 300 years later, the pattern has not changed. Intelligent people are not just bad with money. In many cases, their intelligence is precisely the thing that makes them bad with money. And the psychology behind this paradox is as fascinating as it is expensive. There is a widespread assumption that intelligence protects against poor decision-making. It seems intuitive. Smarter people should make smarter choices. But decades of research in behavioral economics tell a very different story. A 2018 study published in the Journal of Behavioral and Experimental Finance tested over 800 participants on cognitive ability and financial decision-making. The researchers found that higher cognitive ability was associated with greater susceptibility to certain biases, specifically overconfidence and the illusion of control. Intelligent people were not less biased. They were more skilled at constructing elaborate justifications for their biases. This is the intelligence trap. When you are smart, you can build a convincing narrative around almost any decision. You can find patterns and noise. You can construct sophisticated arguments for why this particular stock is different, why this particular timing makes sense, why your analysis is more thorough than the market's consensus. The problem is that the market does not care how clever your argument is. It cares about supply, demand, and the collective behavior of millions of participants, most of whom have access to the same information you do. The takeaway: intelligence is a tool, and like any tool, it can be used destructively. The first step is admitting that being smart at one thing does not automatically make you smart at managing money. In 1999, psychologists David Dunning and Dunning-Kruger published their famous study showing that people with low competence in a domain tend to overestimate their ability, while true experts tend to underestimate theirs. The effect has been replicated dozens of times across various fields. In finance, there is a cruel twist. Intelligent people who are genuine experts in their own fields, medicine, engineering, law, technology, often assume that expertise transfers to investing. It does not. A doctor who understands biochemistry at the molecular level believes she can evaluate pharmaceutical stocks better than the market. A software engineer who builds complex systems believes he can identify which tech companies will dominate. A physicist who models chaotic systems believes she can time market cycles. The confidence is understandable. These are people who are accustomed to being the smartest person in the room. They have spent years mastering complex subjects. It is psychologically very difficult for them to accept that in this particular arena, their expertise provides almost no advantage. A 2020 study by Dalbar found that self-directed investors, many of whom are well-educated professionals managing their own money, underperformed the S&P 500 by an average of over 4% annually over a 20-year period. The smarter and more engaged they were, the more they traded. The more they traded, the worse they did. The takeaway: domain expertise does not transfer to investing. The doctor should be a doctor and let her index fund be her investment strategy. The ego cost of this admission is high. The financial cost of not making it is higher. Intelligent people love to analyze. It is one of their greatest strengths in most domains. But in investing, analysis has sharply diminishing returns, and eventually becomes actively counterproductive. There is a concept in psychology called the paradox of choice, formulated by Barry Schwartz in his 2004 book of the same name. When people are presented with too many options, they do not make better decisions. They make no decision at all, or they make one and immediately regret it, convinced that one of the other options would have been better. The modern financial landscape is designed to trigger this effect: thousands of stocks, hundreds of ETFs, endless asset classes, sectors, strategies, and allocation models. For an intelligent person who wants to optimize, this abundance is paralyzing. A 2023 study from the National Bureau of Economic Research found that investors who spent the most time researching and analyzing their options before investing actually earned lower returns than those who made simpler, faster decisions. The overanalyzers delayed entry into the market, switched strategies frequently, and spent so much time seeking the optimal portfolio that they missed the compounding gains of simply being invested. Meanwhile, the simplest possible strategy, buying a broad index fund and doing nothing, has outperformed the vast majority of professional fund managers over every meaningful time period. It requires no analysis, no expertise, and approximately 10 minutes of effort per year. The takeaway: in investing, simplicity is not a compromise. It is an edge. The time you spend searching for the perfect investment is almost always time that would have been better spent letting compound interest do its work. Intelligent people have a specific cognitive bias that rarely gets discussed. They're drawn to complexity. A simple solution feels insufficient. It feels like it cannot possibly be right because the problem seems complex. So they seek out complex strategies: options trading, algorithmic models, multi-factor analysis, tactical asset allocation. This is complexity bias, and in financial markets, it is devastatingly expensive. A 2019 paper in the Review of Financial Studies examined the performance of retail investors who used sophisticated trading strategies versus those who used simple buy-and-hold approaches. The sophisticated traders had higher education levels, higher incomes, and higher self-rated financial literacy. They also had significantly lower returns. The reason is mathematical. Every additional layer of complexity introduces new decision points. Each decision point is an opportunity for a bias to enter. More trades mean more fees, more tax events, and more chances for emotional interference. Complexity does not reduce risk. It multiplies the surface area for error. Warren Buffett, arguably the most successful investor in history, has spent 60 years advocating for the simplest possible approach. His instructions for his own estate are to put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. That is it. The greatest investor alive does not recommend complexity. He recommends the opposite. The takeaway: if your investment strategy requires a spreadsheet to explain, it is probably too complex. The sophistication is not in the strategy. It is in the discipline to keep things simple when your brain is begging for complexity. There is a final psychological trap that targets intelligent people with particular precision. For many smart individuals, investing is not really about making money. It is about being right. Being right is deeply rewarding for someone whose identity is built on intellectual competence. Picking a stock that goes up confirms their intelligence. It validates their analytical framework. It proves they are smarter than the market. This need to be right leads to a cluster of destructive behaviors. Holding losing positions too long because selling would mean admitting a mistake. Concentrating portfolios in a few high-conviction picks because diversification feels like hedging against your own intelligence. Refusing to follow simple strategies because simple strategies do not provide the intellectual satisfaction of complex ones. A 2021 study in the Journal of Finance found that investor overconfidence, specifically confidence in one's own judgment over market consensus, was the single strongest predictor of poor portfolio performance among high-net-worth, high-education investors. The irony is exquisite. The smartest approach to investing requires you to stop trying to be smart. It requires the humility to accept that you cannot predict the future, that markets are more complex than any individual mind can model, and that the most intelligent move is often the one that feels the least intellectually stimulating. But in investing, staying with the problem longer, analyzing more, researching more, thinking more, often makes things worse. The truly intelligent move is knowing when to stop thinking and start trusting the system. The takeaway: separate your ego from your portfolio. You do not need to be right to be wealthy. You need to be consistent, patient, and humble enough to admit that simplicity beats sophistication in almost every measurable way. There is a painful irony at the heart of all this. The qualities that make intelligent people successful in nearly every other domain: analytical rigor, pattern recognition, confidence in their own judgment, a drive for optimization, are the exact qualities that sabotage them in financial markets. The stock market is not a puzzle to be solved. It is a system to be survived. And surviving it requires a kind of intelligence that has nothing to do with IQ. The intelligence to recognize your own limitations, to resist the seduction of complexity, and to find peace in a strategy so simple it feels almost insulting to your capabilities. Newton could map the heavens, but not his own psychology. 3 centuries later, the question for every intelligent person is the same: can you be smart enough to keep it simple? Your portfolio, and your peace of mind, depends on the answer.